Welcome, students. So, in the process of learning about the financing of projects and learning about the venture capital and private equity, we will further learn about that what are the major differences between the two sources of funding, that the venture capital and private equity. Right. Normally, as I told you, that they are replaceable with each other. People can use the venture capital also, the private equity also. But in the normal course, what happens is that at the initial stage, at the seed stage of the venture, the investment coming in is called as the venture capital. That's a risk capital. But once the project becomes stable, or the venture maybe start giving us the better returns and it becomes sustainable, so the venture capital can be replaced with the private equity. And the cost of funds, when we talk about is, the cost of funds is very high in case of the venture capital, but it's comparatively lower in case of the private equity. So finally, if you look at what is written here, venture capital and private equity are both forms of the private investing, right? This is a private investing because new ventures are not the public limited companies, so public investment is not available, public money is not available to them. So, in that case, they are the, say, forms of private investing, but they target different stages of company development and employ distinct strategies, right? As it is given that they target the different stages of the company development or the venture development or the business development and employ distinct strategies. BC firms primarily invest in early stage, high growth potential startups, often in the technology sector, while PE firms invest in more established, often underperforming companies with the goal of improving their operations and profitability. Right. So that is the normal course. First major means the distinction between the venture capital and private equity is that venture capital comes at the first hand when the project is at the seed stage for the product development, for the test marketing, for the initial maybe setting up of the venture, whatever the funds are required, whatever the guidance of the management is required, that all comes from the venture capital and is a relatively expensive source of the fund because the element of the risk at that stage is very high. But later on, when it becomes little stable, so the venture funds are replaced with the private equity, and sometimes the private equity supports those businesses also which are underperforming. Right, they are doing well, they are profit making, they are doing well, but they are underperforming. So because venture capital cannot stay for the longer duration, they have to take an exit route. So after establishing the business and taking it up to a stage, then they have to take an exit route. So they take an exit route, and finally this source of the funding, the venture capital, is replaced by the private equity. So from there onwards, the private equity investment that helps the business to perform better, grow over a period of time, become sustainable and start earning the desirable rate of return. So initial capital, because it is coming at the very high risky stage of the business, so it's called as a venture capital risk capital. So the cost of capital of the risk capital is very high, the venture capital is very high. So after it becomes sustainable, the business becomes sustainable, and we have to reduce the financial cost also, and venture capital also, or the venture funds cannot stay longer with the business, so they take an exit route. And the benefit of the venture in this process is, or of the business in this process is, that they are able to replace the high cost of capital with the comparatively low cost of the capital, and that is the venture capital by the private equity. And private equity supports the business at its present stage, and if there is a growth potential but it's not doing well, so they inject the additional funds also and help the business to grow at a faster pace. So one comes at the initial stage and second source comes at the later stage, and difference in the cost is also there. VC is expensive source as compared to PE, and when it comes PE, it is less expensive as compared to the, when it comes to the PE, it's less expensive as compared to the VC. So that's the major difference between the two, but both are, say, private sources of the investment, not public sources of investment. So you have to look for the, say, venture funds initially, and later on you have to look for the private equity investors, so that you can grow with the business, make it sustainable over a period of time, till the time it becomes a public limited company and becomes capable of raising the funds through public route and gets listed in the stock market, and then it's eligible for raising the funds through the public equity. Till then you have to use both these sources of funding, venture capital and private equity. So initial stage will be supported by venture capital, and the later stage till the time it becomes a public limited company will be supported by the private equity. So major say differences are listed out here. So number one is the investment target. Investment target is basically the early stage technology oriented products, services oriented products, and heavily dependent upon the external financing, and normally they should be unlisted companies. They are unlisted companies because for the listed companies venture funds are not available. So early stage of the business, if supported by the technology and if they are innovative products, very good, and they should be heavily dependent upon the external financing, and company or the venture should be unlisted company. PE comes at the later stage. It deals in the mature products or services and generally have the large cash flows, and in that case maybe a listed or an unlisted company, but largely if it is, maybe it's written here as a listed, but largely the PE used in the unlisted companies only, because in case of a listed company the public equity is easily available, and there the risk of the business also goes down when the people subscribe to the equity of the firm. So it reduces the overall say risk of the business also. So in case of the listed companies, private equity doesn't play big role, but yes, in the unlisted companies which are at the next stage of the business, have more matured products and has become sustainable now at the later stage of the business, private equity is used as a source of funding for such businesses. Horizon is in medium to long term, and normally in this case the medium term. So medium to long term means 3 to 8 years, you can say normally this is the horizon, and it is 2 to 5 years. So normally you can call it as initially the support will come from the venture fund, then it will be taken over by the private equity, and by that period of 10-15 years the business should become so sustainable that is going to be a self-sustaining business and can take the public route, and they can convert a private limited company into a public limited company and can become eligible for raising the funds through stock market, and maybe allowing the common public to make investment into the business. So that initial period of 10-15 years has to be supported by the venture capital or the private equity. When we talk about the risk involved in this, so in this case at the venture capital level, the investment means at the seed stage level, when the venture capital comes in, it's very risky, means the risk element is very high. That's why the expected rate of return is also very high. But in the private equity level, usually the limited to product market risk. So the risk is almost manageable, it's foreseeable, it's visible. At this stage, the risk is not sometimes visible even. So they have to move in the dark, and they have to make the maybe sometime wild guesses also. Normally everything is based upon the scientific calculations, but sometimes they have to make the wild guesses also and take the chances to take the business from the one stage to the other stage. So when you talk about the riskiness of the business at the VC stage, at the seed stage, at the beginning stage, product development stage, test marketing stage, business is more riskier. But when the private equity takes over, it has become more stable, matured, and the element of risk is comparatively lower. When you talk about in this case, so when you say the structure, so in this case you can say the structure is largely equity or equity type instruments such as the convertible debt or the preference shares. So the venture capital comes in that form, right? And sometime if the investment requirements are higher of the business, so syndication of the venture funds is also possible. So many venture funds join hands, they form a syndicate and jointly make investment in the business, but largely it's a equity type of the investment. And if it is a debt also, so it's not a pure debt, it's a mezzanine funds or junior debt, and later on it has to be converted into either equity shares or maybe any other kind of the equity capital. But normally it has to be in the beginning itself, it can be equity capital or a kind of equity capital which is either a convertible debt, preference shares, or maybe a junior debt which is not a pure debt, but normally having the qualities more of equity, less of the debt. And in this case, the structure is equity and debt combinations. So private equity when comes in the business after this venture capital, and when the venture capital fund take an exit route and it is taken over by the private equity, so it can come in both ways, private equity as well as the debt also. So they can give the debt part of the amount as equity. Accordingly, they can share the benefits. And if the private equity investment requirements of the business are higher, so the many private equity investors, they can form the syndicate and they can make the investment jointly in the business and fulfill the total financial requirements. So next thing is the post financing engagements. venture funds are very active post financing because they know that they are going to take the high amount of the risk. The project is initially at the seed stage. They have to develop the product, they have to test the market, they have to maybe further work very hard to make the product as a successful, or maybe the service as a successful say entry in the market. So they have to work very hard, and it's not only that they are providing funding, but they are contributing in the management also. They are interfering or maybe supporting, I won't call it as interfering, but supporting into day-to-day affairs of the business also, and they are guiding the entrepreneur's team that how to take the business forward. In case of private equity also, the private equity players equally contribute in the business, but not as much as the venture capital investors are doing, because the level of the riskiness of the project at the private equity stage is little lesser. So they are actively contributing, but not active as the venture investors, because at the venture stage the project is more risky. Next thing is the investment management team. Right, investment management team. So normally the team is very professional when the team who is managing the venture funds, or maybe the overall entity, maybe the venture where they are making investment. So the team who are deputed by the venture funds to manage the venture or to contribute in the management of that enterprise, that startup, they are very good professionals. They are either former managers, entrepreneurs with a tremendous experience and vast powerful network in the professional and industrial circles, primarily keeping in mind the post financing engagements or maybe the engagement needs. So this kind of the people are kept by the venture funds who support the venture or the startup or the entity where the investment has been made, so that that investment remains safe, it grows, and venture funds also get the good return at the time of the exit from the venture. And in case of the private equity, they are also professionally very sound people, and they are having the very good background of the financial market, and they know how to manage the private equity in a venture, and ultimate purpose is to manage the risk and to help the business to grow, so that maybe it's a venture investor or it as a equity investor, private equity investor, their funds are safe and the funds are growing. And prevalence when we talk about is, so largely in US and in some to some extent in UK, Canada. So as I tell you that in India, venture capital as such was not existing at all before the, you can call it as around the, say, till the globalization of Indian economy. There was nothing of the sort of the venture capital. What was happening at that time? Who was supporting these ventures? So at that time, this support finance or the venture finance or risk finance was coming from the government through the development finance institutions. If you remember, government created different development finance institutions. Government created IFCI, government created IDBI, government even created NABARD, government created at the state level, state industrial development corporations, government created the state financial corporations. So till the globalization around 90s, beginning of 90s, you can say, there was nothing of the sort, you call it as the venture capital funds or something like that. Today we have more than 500 funds in India, operating in India, who are providing the venture capital support, and this process has started largely from 1988. Before 1988, this total venture finance or that investment support was being provided by the development finance institutions. At the central level, it was IFCI, Industrial Finance Corporation of India. It was IDBI, Industrial Development Bank of India. Now it is a normal commercial bank. At that time, it was a development finance institution, and then NABARD was also created. At the state level, there were the state industrial development corporations and state financial corporations. They were providing normally the risk capital to the entrepreneurs. But after this 1988, first venture fund was registered in India in 1988, and after that this you call it as say number of venture funds came to India. Indian economy became a global economy from 1991, 24th July. So after that it became professionally equipped economy or maybe a supported economy, and many funds from the other country, US, UK, Canada, Singapore, Israel, Japan, they started coming to India, And now India also has a very good VC culture, very good large number of the VC funds, more than 500 funds are existing in India. And the same is the case with the private equity also, which was professionally existing in the other countries, advanced countries like US, continental Europe, Asia Pacific, Japan, and many emerging markets. But in India also now we have the very good network of the private equity investors, and even the financial institutions are becoming very good source of the private equity, and they are also supporting in case of the exit by the venture funds. Financial institutions are also making investment in the form of the private equity in the ventures which have proven its mettle. And then we talk about the term sheet. Term sheet means when private equity has to come into the business at the time of the exit of the venture capital, there has to be a proper, you call it as a document which has to be created, that how much capital will come from the private equity investors, how that investment would be managed, what would be the role of the private equity investors, and how they will support the business, to what extent they can interfere into the affairs of the business, what kind of the honesty and integrity they can expect from the say team of the promoters or entrepreneurs, and how they are going to make sure that whatever the investment they are going to make in the company, that's going to remain safe and that's going to grow. So you look at it, it's very clearly written that private equity funding has been gaining importance in the last few years, right? It has been gaining importance in the last few years, and as I told you, this movement has started. The venture capital or private equity movement has started around 1990s, and the first venture fund was set up in 1988. So it is further written here that starting point of the PE funding is a term sheet, right? When they move into the venture and they want to support the venture, so they create a term sheet which reflects the understanding reached between the PE fund, the investors, the promoters, means the investors, between the PE fund, so which reflects the understanding reached between the PE fund, that is the investors, the promoters, and the company. So these are the three important stakeholders. So this is the understanding has to be between the investors, who are going to be private equity investors, the promoters, who are the entrepreneurs, and the company, because if it is a private limited company even, so sometimes some of the things are even distinct from the owners of the company in the company, even if it is a privately held company. In the public limited company, there is a complete separate legal entity. Public limited company is totally separately existing as compared to its owners. So owners are not known by the company and company is not known by owners, but to some extent in the privately held companies also, company has its own entity. So there become three important stakeholders: investors, promoters, and company. It summarizes the terms and conditions for the proposed investment in the company, means the term sheet. It is followed by due diligence and then by the shareholders agreement or the shareholder subscription agreement, right? So proper means term sheet is created, then it is followed by the shareholders agreement or the shareholders subscription agreement, because when the private equity is invested, so the shareholders, they become the shareholders, kind of private equity investors become the shareholders, and there has to be a proper agreement that what is their claims, rights, and responsibilities in managing that investment. Finally, the provisions of the shareholders agreements are included in the article of association, which is the first book when we want to, second book rather, when we want to convert the business in the form of a private limited company. So initially it may be a sole proprietorship, then it may be a private partnership firm, and when it has to be set up as a private limited company, so we need two documents for its registration: memorandum of association and article of association. So that shareholders agreement, which is developed after the say development of the term sheet between the investors and promoters and the company, that say shareholders agreement becomes a part of the article of association, and then it takes a legal shape, and finally the total private equity has to be managed as per the terms included in the term sheet and the shareholders agreement. So standard term sheet covers the following things. Number one, it is a company in which the private equity is being invested, promoters who are the owners of the company, investors who are the private equity investors, quantum of investment going to be made, and investment instrument, in what form the investment is going to be made. Normally it is equity, but it can be debt also. Pricing of the instrument at normally that if it's in the form of the equity, then what is the normally if it is the price of the share, means price of the one part of the capital would be how much, and similarly the bond price or the say debt instrument price. Then conditions precedent. So what conditions are going to govern this investment in the company? Then finally the funds are deployed, or in the firm they are given to the firm, and where the funds would be deployed, for what kind of the purposes the funds would be deployed. So that would be another thing. And after that, what are the subsequent conditions? Means once that investment is coming, funds are deployed, and now they have to be managed. So who would be contributing to what extent? Private equity team or maybe the investors representatives would be contributing in the management of the affairs of the firm to what extent, and what would be the joint collaboration between the private equity investors and their representatives and the entrepreneurs and the management team. And then the shareholding pattern would be what? That to what extent out of the total say capital, you call it as the size of the firm, so the total capital investment in the firm, what percentage of that would be given to the private equity investors. Normally the ownership component is kept intact by the owners, by the promoters, so they keep in their hands more than 51% share, or more than 50% or 51% share of the company's total capital. Remaining a minority stake is given to the private equity investors, so that ownership remains in the hands of the entrepreneurs or the promoters. Then board representation by the investor. Who would be and how many representatives of the private equity investors will be in the board, and preemptive right of the investors, that tomorrow if any stock has to be sold to the public, first it will be offered to the private equity providers. So in that case, that's going to be a first condition, that for any kind of the say changes going to take place, first it will be asked from the existing investors. Promoter lock-in and investor right of the first refusal. So normally say promoters will also stay in the business, they cannot leave the business, they cannot change the ownership structure, and investors right of the first refusal, that tomorrow if any new shareholding has to be issued, then first it should be offered to the existing private equity investors, and if they refuse, then only it should go to the say next say group of the investors. And investors veto rights. Sometime if any decision is being taken by the company which is not in the interest of the overall growth of the company, so investors can veto, that is also the part of the term sheet. Then investors exit rights. So how the private equity investors will exit when the firm grows and want to become a public limited company, that would be clearly defined. Non-compete and non-solicit for employees. So it's an important condition for the existing employees of the company, that tomorrow if they leave the company and they open up their own business almost in the same sector or same area, so they will not become the competitors of the existing business, and they will not influence the existing employees or customers of the company in which they are currently employees, and tomorrow they become the entrepreneurs. They will not solicit or they will not influence the customers of this company or maybe the employees of this company for their own benefit or benefit of their new business. Representation and the warranties, accuracy and indemnity. So whatever the information provided by the promoters or entrepreneurs to the private equity investors, that would be true, and in case of any information becoming or coming false at the or proving false at the later stage, so the entrepreneurs will compensate to the private equity investors. There will be proper qualified investors in the appointed for auditing the affairs of the company. In every aspect due diligence will be used, that is the another important requirement. Definitive documentation, all the documents, whether it's a memorandum of association, article of association, or maybe other important documents maintaining of the accounts books, that have to be as per the rules and in a definitive process. All the affairs would be confidential, so confidentiality would be properly maintained. And exclusivity, that is the exclusivity means at any point of time if anybody want to go out of the firm, so and if you want to sell his stake to some outsider, so that outsider will have the right verify the affairs of the company before subscribing to the shareholding. And then is the validity, financial soundness, that from every aspect it will be tried that company remains financially sound, and nothing will be done by any of the promoters or entrepreneurs to disturb the financial health of the company or maybe to downgrade the operating or the financial structure of the company. And finally the governing laws. So normally the private equity or maybe this kind of the investments are governed by 2-3 acts. One is the Companies Act 2013, then SEBI's AIF regulations 2012 and recently amended in 24, FEMA and Income Tax Act. So whatever the affairs of this venture funds or maybe this firm which is under the private equity or being supported by the private equity investors, it is working as a privately held company, as a privately held business, will be governed by the Companies Act because it's again a private limited company, and SEBI's AIF regulations 2012 and recently amended version 24, FEMA and Income Tax Act. These laws ensure compliance, transparency and protection of all parties involved in the private equity transactions. So these laws, under these laws, the company will work, the business will work. Term sheet and its all terms will be taken into account very carefully. Everybody would be responsible to protect the terms being mutually agreed, and finally all efforts would be made by all to take the business from the one level to the other level. The Indian VC industry, as I told you that Indian venture capital industry has grown in the recent past. Right, it has grown in the recent past, and before that I told you that the venture capital was being provided by the Indian development finance institutions. Indian development finance institutions were your IDBI, IFCI, or maybe your this state industrial development corporations, state finance corporations. So they were providing the venture capital, but at that time the life of the entrepreneurs was a little easier because these institutions were not using very stringent ways or means of say evaluating the venture or the businesses, and they were found to be little liberal as compared to the venture funds or the private equity investors for supporting the new ventures. But now, after this emergence of this venture capital and private equity era in Indian economy around 1990s, and as I told you that the first venture capital fund was set up in 1988, which was known as ICICI Ventures, and before that it was known as TDICI Limited. So this was the first venture capital fund which was set up in India in 1988. This was with the support of the ICICI, and finally it was named as ICICI Ventures. So this was the first fund, came in 1998 to India. Before that nothing of the sort was there, and this venture capital and private equity culture was more prevalent in the developed economies, USA, UK and European countries. After this emergence of the first ICICI Ventures in 1988, many now the foreign funds are operating in India, and they are supporting the say venture growth or the venture development in India. They are providing the liberal support, but after due diligence and the proper careful analysis and evaluation of the ventures, once they find that the venture is going to be successful and their product or idea is very good, so they provide the funds. So this, say, you can call it as a critical evaluation. Rigorous evaluation maybe is very good also for the ventures as well, that once they are approved, means evaluated and approved by the international investors, so there is hardly any reason that the venture will not be successful. So it's in the interest of the entrepreneurs also, it's in the interest of the other investors also, employees also, that the venture funds being very capable of making all kind of analysis and say evaluations, they are playing a very critical role. So this rigorous and diligent evaluation of the new ventures is going to help them to make them sustainable and to stay in the market for longer duration. And investment preference of the VC investors have constantly evolved. Over the years, there has been a shift in favor of the financing, the expansion plans of the firms already in operation as opposed to the greenfield ventures or the startups. So it means now initially they were supporting the greenfield projects also or the startups also, but now the culture is changing over a period of time where the venture funds are more interested in the PE kind of investment, private equity kind of investment, rather than giving the venture funds. But still there is a sufficient supply of the venture capital for the new ventures also, and if anybody want to become entrepreneur, they can approach the right venture or the right fund, and they can give the appropriate support, financial support to the newly ventures coming up. So later on, for the private equity or in the form of the private equity, the support is liberally available, but at the venture level also, initial level also, at the seed stage level also, the funds can be arranged provided the venture has a promising idea and that has the potential for the growth. Finally, we can say that in early years in India, that is in 1988, industry was characterized more by the VC style of investing, right? When we talk about, because till 1988, development finance institutions were providing the venture capital. So anyway, they were supporting the new ventures. Initially, after 1988, when the first venture fund came into existence, that was ICICI Ventures in 1988. When it came into existence, they also started supporting the new ventures in the form of the venture capital, or by way of providing the venture capital. But now the trend has a little changed, and now the promoters are being asked, entrepreneurs are being asked to prove their mettle first, and more funds easily would be available for the expansion or growth of the venture, so that in the form of the private equity. But you can't say that the venture capital is not available in India. Venture capital is also available in India. We have more than 500 venture funds operating, Indian as well as the foreign funds operating in the country. Only requirement is that your idea has to be promising, your idea has to be have the growth potential. Then there is no shortage of the funds, and you can easily get the funds from the market. And before we close the discussion on this, next thing is that we are going to talk about is that is a regulation of the VC industry in India, venture capital industry in India. That's also a very important requirement. So when we talk about the regulation part, we all understand that there are the three important entities which are helping us in the regulation of the venture funds. And Indian Companies Act 2013, because any venture or any project is being set up, that is maybe finally going to be a private limited company. So naturally, Indian Companies Act 2013 comes into effect, and that becomes an important regulating law in the country for regulating the ventures if they are operating in the form of the private limited companies. And for the further regulation and control, SEBI is already there. So SEBI's Venture Capital Fund Regulations 1996, they are very, very effective. You can call it as the teethful, say, part of the regulation of the venture capital industry. So SEBI is a very effective regulator. It's playing a very important and critical role in regulating the venture capital industry, though it's not say regulating under the Companies Act. Companies Act comes into effect because the venture itself is being set up as a private limited company. So naturally, the Companies Act will come into effect. But as a regulator, SEBI's Venture Capital Fund Regulations 1996 are the important provisions where the SEBI is effectively acting as a regulator, and they want to make sure that VC is these ventures are depending upon the private funds only. They do not have any access to the public funds. And finally, these funds which are being raised by way of the venture capital or private equity, they are being invested into the unlisted companies. And Section 1023FB of the Indian Income Tax Act exempts the income of the venture capital funds by way of dividend and long-term capital gains from the tax. So it's an exemption to these funds. So naturally, these funds will grow, and their income would be tax exempt. And for the foreign funds who are operating in India, as the venture funds who are operating in India, so they are being governed under the FDI and FII rules, or that regime or that system. So as far as the regulation of the VC industry in India is concerned, so we have the very effective regulation. SEBI is regulating it. Indian Income Tax Act is also playing its important role, and because these ventures finally means the companies or the projects, they are being set up in the form of the private limited companies if they are the private limited companies. So naturally, Indian Companies Act 2013 also comes to play an effective role and acts as an effective regulator. And the next thing we are going to talk about is that current concerns for the Indian VC and PE industry. So these are the important points just to be borne in mind, that competition for investment and unattractive valuation levels. So you can call it as these are the important concerns which are to be borne in mind, and this is more a concern for the policy makers, for the government, for the regulators, so as to protect the interest of both the funds also, the venture funds, private equity funds also, as well as the borrowers also, where means the investment is going to be made, because there can be sometime unhealthy competition amongst the funds, and due to that they can make some say unattractive investments also, because they don't want to go for the detailed valuation because of that competition. So sometime it becomes a very risky situation for the these venture funds also, right? Sometime there are uncertain implications of the current slowdown in the global economy. So there is no demand for the capital. People don't want to become entrepreneurs because there is no demand for the products and services in the market. So sometimes they face a concern that they want to make investment into the ventures, in new ventures, but the capital is not being demanded, and there is a lack of good appropriate investment opportunities. So that's another concern which jointly have to be addressed by the government, by the market forces, by the regulators, and by the funds, as well as the budding entrepreneurs. And sometime in giving different kind of the approvals and sanctions at different levels, some intentional delays are there, which are again going to affect the say the venture capital industry or the private equity industry. And shortage of the professional managers is a major concern. Managing the venture funds and the private equity funds, and even the new enterprises which are set up by the new team of entrepreneurs or by the startup owners, managing those ventures, all the three things, for the management of the venture funds, private equity funds, and even the startups or new investment projects, there is a shortage of the professional managers, so which has to be addressed. Many business schools are producing very good young graduates, means who have the background of the financial markets or the knowledge of the good management of the say financial aspects of the businesses, but still there is a shortage. So these are some important concerns of the VC or PE industry, but still this industry is growing at a faster pace. And if anybody want to make investment into any promising idea, so funds are easily available. So venture funds are also available, and once it becomes a sustainable business, so for the growth the private equity is available, private funds are easily available. And last thing we are going to talk about is how to approach a VC fund. When you want to set up your own business or you want to set up your own venture, how you can approach the VC fund. So you have the 4 steps to follow. First thing is, select the VC fund you want to dialogue with. Means you talk to them, means there should be a complete list of the funds available with you. Try to understand their say investment profiles, go to their websites, look at their brochures, try to understand before talking to them that what kind of the products or industries or services they are investing into, what is their total investment behavior in the past, how many industries or maybe the businesses they have invested so far, and what is the normal condition of those businesses. So first you should know that who is going to be your potential investor, and you have to have the complete knowledge and you have to conduct a detailed study of your potential investor. So this is the first thing. And after means studying and knowing about and making sure that this fund can make investment into our business, so you have to go for the dialogue for discussion, and finally you have to maybe start the process of getting the investment from a venture fund. Number 2, present an exciting and convincing story. When you go to the venture fund, you go with the proper detailed presentation, and if it is possible, then you go with the detailed project feasibility report, which should have a clear description of the project idea, market and demand analysis, technical analysis, financial estimates and projections, even the investment criteria evaluation, and then maybe the riskiness of the project, means the evaluation of that, and finally means what cost of capital you are going to expect and you are going to give the rate of return back to the VC investors. If you go with all this information and make a presentation to the VC funds, they may carefully listen to you, and you may be able to successful to get the funds for the business or the amount of the funds you want to raise for your business. Next thing is, choose the right investment partner, because it's not only the question of taking the investment, rather you have to have the post investment relationship also, better relationship also, harmonious relationship also, because these funds, they simply do not provide the funds in the form of venture capital or private equity, but they participate into the management also, they contribute in the management process of the business also, into the overall say performance of the firm also. So there comes some kind of the conflict of interest, or maybe the conflict of the policies, or maybe the programs, or maybe the business management tools and techniques which they want to follow, and sometimes the entrepreneurs may not like it. So we have to maintain a proper relationship, harmonious relationship post investment also. So always take that into your mind, that your investment partner has to be correct and he has to be means like-minded, so that they can give the funds also and they can support in the promotion of the business also. And lastly, be prepared for an open relationship. Not hide anything with them, because they are going to provide the lifeblood of the business, that is the finance. And if you hide anything, as we do not hide anything from the doctors or the lawyers, same way you don't hide anything from the investors, maybe the venture funds or the private equity. You keep everything open to them and express your requirements as well as the terms and conditions you want to have with them in advance, or maybe in a very open and in a very clear form, so that tomorrow if you and those investors join hands, so both of you can work as a team and take the business to the next level of the progress and growth. And finally, a startup which may be started as a sole proprietorship becomes a transnational company in a short span of time. So with this, we will stop the discussion on the financing of the projects and important source of financing, that is the venture capital and private equity. For the detailed reference, you can use different sources like books and different maybe the publicly available sources, but the broader perspective of the venture capital and private equity I have discussed with you here, and they are the important sources of funding the new projects and supporting them for the growth and development. So in any case, if you want to set up your own business, you can know that how to approach the venture fund and maybe what kind of the support and what kind of the maybe management contribution they do and how they can help you to grow with the business. And later on, you should know it that at what stage they have to be maybe given an exit route, and you have to replace the venture funds with the private equity, and then this private funds with the public money, public capital you call it as, after converting your private limited company into the public limited company and growing with the business. So with this discussion, I will stop here at the moment, and for the remaining discussion on the remaining topics, we will meet in the next class. Till then, thank you very much.